I get a lot of DMs. I get a fair few messages about I've got a limited budget. I've got $400,000, $500,000. What should I do to climb the ladder as a investor? Should I even consider real estate, or what else is there when it comes to buying property? Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, a code cracker, yes. We're talking inexpensive real estate. We're digging into what you should do if you've got a limited budget in Australian real estate. Of course, Australian real estate is expensive, isn't it? It's not cheap. It's not a can of Coke. It cost a few bob to play the game. And of course, real estate is a game of leverage, and the more leverage you can get into the market, the better off you're going to be. But real estate is a long-term vehicle. And for a lot of people, the relationship with starting out, buying an inexpensive property and going the distance over a long period of time seems very, very daunting. And is it even possible? We're going to explore that today. So, hey, welcome to the show. Of course, regulars, you know the drill. And if it's your first time tuning in, well, we have a saying around here: play the show in double speed, get your life back. You only have one of them. And of course, all the episodes I've done are actually lessons on real estate. So feel free to go back in time and explore some past episodes that may rock your boat. So I get a lot of DMs. I get a fair few messages about I've got a limited budget. I've got $400,000, $500,000. What should I do to climb the ladder as a investor? Should I even consider real estate, or what else is there when it comes to buying property? Is sub $500,000 real estate a good idea in the Australian property marketplace? And it's a fair question, because we're all trying to get ahead in life, and it's probably fair. The Australian government doesn't want you to get ahead, do they? They want you to be taxpayers till you're 70. They can't have everyone becoming financially independent and leaving work in their 50s. That may not add up mathematically in their world to what they want to achieve, which is, of course, growing the country. So there's always a battle. We've got to grow ourselves, and we've got to fight the power. As the great rappers once said, Public Enemy, fight the power. So a lot of people obviously have bought their family home and spent a mozza. And of course, then a lot of people go out and use some equity from that family home and turn that equity into a deposit to go off and buy an investment property. And of course, because family homes today are very, very expensive, their buying power thereafter to buy an investment property is quite often very limited. And one of those limitations is getting into the market sort of sub the mean average of real estate. So it's a real thing today. People deal with this every day. And of course, one of the easiest ways to accelerate your wealth is, if you're not living in your dream house, just rent out your house and go live somewhere else. And of course, all of a sudden you can turn a non-income producing asset into an income producing asset. And of course, bite the bullet, so to speak. And that should increase your buying power so you can buy some formidable assets in the real estate market. But for most people, they want some stability. They want their family home. They don't necessarily want, to rent another home in this marketplace. So there's obviously trade-offs when it comes to property choices. And it's common for every property to have trade-offs. You could have a beautiful property close to the city, but the trade-off will be it's very, very expensive. So as a property investor, even if we're sub $500,000, we've got to explore the trade-offs. The other important point when it comes to investing is opportunity costs. So to choose one property over another is really the opportunity costs. So if you buy a property and it performs less impressively than another property, you have wasted opportunity. And obviously that comes at a cost. So for property investors, it's a game of trade-offs, opportunity costs. Did I say cough? Wow, opportunity costs. No, opportunity costs. And really, when we come to thinking about real estate, obviously it's margin-based, so marginal thinking. By way of example, could $20,000 more spent on a property get you 100% more real estate as an investment? Could just going that extra $100,000 up in price range actually double your growth rate? This is the marginal thinking behind any investment when it comes to real estate. And of course, there are ways to play the margin game, which is really the game of real estate. A game of leverage, a game of trade-offs, a game of opportunity costs, and a game of margins. So if you've got a limited budget when it comes to real estate, and again, it's perverted to say sub $500,000 is a limited budget today, but it is. That's the reality of the world we live in, an inflationary world where things cost a lot more than they ever did. But firstly, when it comes to real estate, you could actually be better delaying buying property altogether. Sometimes opportunity cost is also just sitting out of the market. So you need to sort of also weigh up, will rates come down, which will increase your buying power? Will prices actually come down, which will increase your opportunity? Will wages rise, or will debt change? These are the playbooks when it comes to really understanding the leverage side of the equation. And of course, as a property investor, you've got to sort of weigh up the pros and cons of sitting out of the market. Will the market actually go up in value? Will that actually diminish your opportunity, or vice versa? If you jumped into the market, will it go down in value and then you're effectively owning a property you probably paid too much for? So restructuring debt is one way to borrow more money. And again, the game of leverage is an important game. So when people ask me, should they, buy a property for sub $500,000, $400,000, first thing I say, is there any chance you can have a look at your debt situation, restructure debt? That could be their principal place of residence, actually restructuring what that debt looks like, spreading out the loan term. It could be turning a loan into a 30-year loan instead of 20 years left on the loan to spread out the debt to increase the buying power. Obviously, becoming wealthy out of real estate is just a game of getting capital into the market. The more spread of capital you've got, the better off you're going to be long term. And it's fair to say the more expensive real estate tend to get a faster rate of growth, and also incrementally in dollar figures tend to get paid a lot faster in dollars than less expensive real estate. In other words, $1 million property goes up by 10%. You've got $100,000. $100,000 property goes by 10%. You got 10 grand, right? So the dollar increment is obviously incredibly important to wealth creation. So you can restructure debt before you even consider buying. And this is where a good broker comes into play. Now, I'll assume everyone's had a chat with a good broker and they've been through things like restructuring debt, restarting home loans, trying a new bank, even trying a new broker. So remember, there's kind of 4 levers to the situation. You can change debt, and changing debt will allow you to borrow more, so you don't necessarily buy the cheapest, silliest property out there. You want something, obviously, that's going to work. Obviously, you can change your wage, and changing your wage allows you to borrow more money. And if you can advance your career, grow income streams, improve your financial well-being, argue for a higher salary, learn something and effectively use that to bargain for higher rate of pay, you're obviously going to be able to borrow more money. Now, for a lot of people, they can borrow more money, but they look at real estate from a conservative lens. And I can tell you it's probably not the best thing to do. Again, I've met people who can quite easily spend $800,000 on a solid piece of real estate, but are choosing, because they don't want to bite off, in their view, more than they can choose, to invest in a $400,000 piece of real estate. Well, let me just tell you that the results will be chalk and cheese between the two asset classes, with the ability to have a safer, better property by actually spending a little bit more money. And of course, interest rates play a part. Now, we've obviously right now, as I record this podcast, probably at the peak of the interest rate cycle. Really, most economists believe the interest rates will go down, and by this time next year, you'll shave a full percentage basis point off the cash rate. So that will increase most people's buying power by anywhere from $60,000 to $100,000. And again, you've got to ask yourself, in the next 12 months, will real estate go up $60,000 to $100,000, or would you actually be better off waiting to buy real estate, particularly if you're at an entry-level point, to push you up and help you buy something that's more attractive to the market down the track. And again, it depends on a lot of parameters: your wage, your current debt. But for the most part, if the interest rate or cash rate comes down, your buying power will go up. And of course, that in itself is a bit of a game for people. So I would say that, if you're sort of shopping in that sort of $600,000, $800,000 market, you've got choice. So you don't really have to wait for the interest rate markets to play. But certainly if you're in that $300,000, $400,000, $500,000 bracket when it comes to purchasing, it may actually be better to just cool your heels and effectively come back when interest rates are actually more affordable. Now, a lot of people will argue that point and say, well, you just got to get into the market when you can. So if that's the case, then let's explore just getting into the market and having a bit of a crack. Now, it's important to understand the average income required to service a new mortgage in Australia today. The average with a 20% deposit, according to CoreLogic, is 46.2% of people's income to service a mortgage. So you can see right now it's rather high as to what it costs to service a mortgage. December 2020, you were closer to sort of 34%. Now we're at 46%. And it's a very important figure, the median household value in Australia, because the median is really the midpoint of the market, what people at a mid-level are paying for real estate. And at a mid-level, it's circa $750,000. So why that's an important figure is real estate that sits at $750,000 is kind of the average look and feel of Australian real estate. If you go and spend $1 million, you're going to get a better property. If you spend $2 million, you're going to get a way better property. And if you spend $400,000, you're effectively about 40% off what the middle Australian person is paying for Australian real estate. So you're obviously going to get a less impressive property if you cannot keep up with the median price of Australian real estate. Now, all cities have different median prices and all suburbs have different median prices. So we can explore changing market and, of course, explore having a look at some different suburbs when it comes to real estate. But things have jumped. You know, again, if you went back to pre-COVID, sort of circa October 2019, you were $574,000 as a midpoint, a median point of the market. Today, it's $750,000. So at 574, there was a good level of midpoint properties in the Australian real estate marketplace. Now, all those midpoint properties are effectively $750,000. So there is an opportunity to look at different typologies. And again, you can drift away from the house price and you could go, for example, to the unit market, the apartment market. Now, some rules about buying apartments, and there is money to be made from buying apartments, that's for sure. But again, it needs to be no different to a house, the right street, the right curbside appeal, the right design, the right building. But the difference between houses and apartments today is some sort of $200,000. So if you are a buyer, sub 500,000, you could potentially explore the apartment marketplace as well. And again, there's just a lot of affordability in that space. So again, if we go back to marginal thinking, trade-offs, these are all the discussions you've got to have if you're going to be a sub $500,000 purchaser. Do you go regional? Do you go into an apartment typology instead of a house? When we examine the regional marketplaces, one of the challenges with regional at the moment is regional is not exactly much cheaper, certainly when it comes to the housing market. And you probably wouldn't want an apartment in a regional economy. So if you look at the house affordability metrics, the capital city versus region effectively is virtually the same. And the years to save a deposit in regional or capital cities today is exactly the same. So we've been through that regional migration phase where people flooded to the flight to affordability of lifestyle communities. Today, it's no different. Once you get there, it's now ultimately expensive and very similar to the median price of capital cities. Of course, that doesn't mean that there is no affordable regional marketplaces. There certainly is. But again, you can see what is happening. It's a funnel, and the funnel drifts down and your choices become less unless you can keep up with where the median point of the market is at. So again, there are a couple of ways to play it. Do nothing. Wait till the cash rate works itself out. Or you could actually invest and work out how to make money, but potentially how to play the game over a shorter period of time. It's really all we can do about this situation. And it really always starts with maths. And again, if you get buying an investment property wrong, which is at the bottom end of the price metric, you can find yourself going backwards. Now, if we analyze really the true nature of mathematics and investing, you've got a capital growth rate, you've got an inflation rate, you've got mortgage costs, and you've got a net return on your investment from the rental yield. So again, after accounting for maybe some tax deductions, if you don't have a very good capital growth rate over the long term, the inflation rate can sometimes bury the capital growth rate. And obviously, if you've got mortgage costs and rents which don't pay for the mortgage, then you will go backwards in real estate. You will go backwards in wealth. Now, by way of example, if you had a capital growth rate of just 3%, an inflation rate today which is 4%, mortgage costs at 6%, and a net yield at 3.5%, you would actually be going backwards by 2.2%. You're actually losing money to try and create wealth. And it's very important to understand that in itself is a probability if you get the investment wrong when you buy at the bottom price range of the marketplace. So it's very important that the property you choose is going to get a decent level of return, rent, and also capital growth. And sometimes cheaper properties have a higher rental return and lower capital growth rate. You've just got to be really comfortable with that fact. But ultimately, we want at least 10% total return from capital growth and rental return. It's an important framework because if you are investing below the mean, there is a high level of risks that the properties may be below the average because of poor location, issues with the building, low rental demand. There's a reason why the market has not paid for that real estate already. There's a reason. There's a reason why the price is inexpensive. The consensus of real estate is always built into the price. However, in saying that, some inexpensive properties have value add opportunities. They could just be an unloved little diamond sitting in the rough. And of course, some markets have just been slow to grow, which may mean into the future that low growth will revert and growth will actually hit that asset type. So remember, if you are shopping below $500,000, there is an economic principle called greater fool theory. And though it seems cool to buy a property which is inexpensive, you have to always think about real estate. Is someone else going to come along and pay more for the same property that you have bought? Really, greater fool theory is hoping someone else is effectively out there to buy the asset more than what you have bought it for. Now, we can avoid greater fool theory by actually having some rules around buying an inexpensive property. And the first rule, I think, which is really important, is a defined time horizon approach. Now, real estate has a cycle. It goes for 18 years. It's a business, economic, macroeconomic cycle. It basically concludes that there's going to be structural change over an 18-year period for real estate to transform. And that is really the transformation of technology, businesses, ideas, the populace. It really all transforms over an 18-year period, and real estate sort of gets a free ride off that transformation. However, as a stepping stone piece of real estate, which sometimes people buy as their investment, you probably want to have a look at the real estate over a 5 to 7 year period as your defined time horizon, and also just conclude that you're buying the real estate eventually to sell it, to upgrade to better real estate down the track. And you can upgrade to better real estate because if you can see your entry-level property grow, create a dividend for you, create some more seed capital for you, you can actually redeploy that money into a better piece of real estate. Now, you just have to come to terms with the fact that if you are doing a strategy like that, you will have things like capital gains tax, which you have to deal with, entry costs such as stamp duty, and exit costs such as resale fees. So you're going to need the real estate to do something to cover those costs. And of course, you can go and listen to podcasts I've done on capital gains tax. What you don't want to do is buy a property that is not the best asset and also do it at the top of a marketplace, and then the marketplace drop in value. Then you're locked in for 5-10 years negative equity on a property you absolutely hate, full of repairs, maintenance, functionally obsolete. You just don't want to go down that path. And again, sometimes investment sounds sexy, but there's the downside of the process. So when it comes to buying inexpensive real estate, it's the same principle as buying very expensive real estate. You want differentiators in your real estate. Now, you can go down the AAA model, A-grade land, A-grade build, A-grade location. The trouble is the less expensive real estate isn't technically in an A-grade location, usually is not A-grade land. The building quite often is not a architectural masterpiece of A-grade build quality. So you're going to have to come to peace with that as well. And as an investor, though, what we can do is try and go into a suburb which is going to be less expensive, but use the same model. A-grade for that suburb, A-grade location for that suburb, A-grade land for that suburb, and an A-grade design for that suburb as well. So obviously we're going to get pushed further out if we're going to be an entry-level investor, and whether it's an apartment, townhouse, or house, we've just got to come to terms with the fact that at least let's follow the principle of try and get the best possible property for our budget. And I always use the principle of the 4X growth plan. And if we start with location is going to be a big part of the puzzle of investing in real estate. Now, you could start with the market, obviously narrow down where you want to buy: Perth, Brisbane, Sydney, Toowoomba, Geelong, wherever it is. Then narrowing down your funnel to a location. Now, really, when it comes to the location, what you want to look for is a theory of economic geography. So you might have found a property. If you go online today, and I went online before to search $500,000 properties, houses in Brisbane, and really Mildura came up. That's what basically happened. But it is possible still to buy properties, whether they're houses, townhouses, or apartments in our major capital cities. And what you're looking for as a location strategy is economic geography. How does the geography work with the city? And you can narrow it down to two concepts. One is the neighbourhood effect. The other is the halo effect. The neighborhood effect is effectively, do people actually want to stay in the neighborhood and not leave? Now, for the most part, I think when you're shopping at a very low rate, most people in the neighborhood want to leave the neighborhood. They don't want to stay in the neighborhood. So you're going to struggle to get this retention of people who want to stay in the hood. However, there is another principle, which is called the halo effect, which effectively is people outside of the suburb want to get into the suburb. In other words, people are climbing over themselves to want to live in that neighborhood. Now, the best real estate gets both the neighborhood effect, people wanting to stay, and the halo effect, people wanting to come, and hence gets effectively more demand than there is stock, and that lifts prices. So to drive the halo and neighborhood effect, you need an agent of change. What will bring people and keep people to a place? And of course, for property investors, this is what they need to look for if they're sub $500,000 investors. They need a clue that tells them that something's going to change that's going to lift value. And the agent of change could be infrastructure. It could be government spending. It could be structural change from a population shift to the neighborhood. What is going to change the state of an area? Is it just greater fool theory, more people spending more money, but really there's no fundamentals? Or is it an agent of change? Now, I recently had a look at an area in Melbourne. It's probably 15 Ks to the city. It's getting an agent of change. It's actually getting rapid rail. It will mean that that particular precinct is not 7 stops to the city, it's 3 stops to the city. So all of a sudden, instead of taking 40 minutes, it's going to take 20 minutes. That is an agent of change. That means people will look at that area through the lens of the halo effect, whereby people will go, wow, okay, that's not bad. I can be into the city in 20 minutes. I can be to the universities, the medical precincts in 20 minutes. I think has improved that area. Let's go check out houses in that area. Of course, people in the neighborhood go, wow, now all of a sudden I can stay. I don't have to leave this horrible neighborhood. I can stay in this horrible neighborhood because all of a sudden this neighborhood is more appealing. So again, from a location point of view and a limited budget, the biggest tip I can give you is you need the agent of change to create the halo effect and the neighborhood effect. And obviously that change, if you can land on where that change is going to happen in that 5 to 7 year period, you're going to get a beneficial result of capital growth from that move. Effectively, an area tends to grow because of land use and that it is zoned for growth. The idea a location is the agent of change is essentially it is modeled for economic growth. Government is spending money that will drive change. So it could be a new roadway. It could be a new freeway. It could be a new train line. What is going to create a neighborhood effect of people wanting to stay in the neighborhood and a halo effect of people going, wow, well, that neighborhood really is going in the right direction. And so I've done this before. I've bought a property using the agent of change, whereby it was an inexpensive property at the time. And there was an extension to a freeway, which was going to create a massive change of travel distance to that particular suburb. I bought in the suburb within 5 years of buying in the suburb. The real estate had gone up to a point where it was just perfectly poised. I could have either sold the real estate. I actually chose to keep it because the agent of change was just so good. So you can buy affordable real estate and get a result from it. The other way to look at affordable real estate is the next door effect, often referred to as the ripple effect in Australian real estate. Of course, the ripple effect is, mirrored off, the pond. You throw a pebble in the pond, you get that ripple, and eventually it makes its way out to the edge of the pond. As prices climb, people tend to circulate around where the better real estate is. As they can't afford it, they simply go to the next suburb along if it mirrors the suburb that is the one that everyone wants. And of course, it can lead to increased property prices and demand because you're getting effectively the same infrastructure and amenity, albeit you've got to travel 1 or 2 more kilometers further down the track. And of course, I think we've all seen examples of the ripple effect benefiting property investors. So what you need to do is find an area that you know is strong and look next door. Could you pay hundreds of thousands of dollars less just by buying 1 or 2 kilometers away? And will there eventually be a esteem valued attached to that suburb next? So will you get that halo effect? And of course, I think by just examining those 2 pillars of location strategy, as an entry-level buyer, you will win. What you probably don't want to do is just jump into a location because it's affordable, but it's got no agent of change. It will just remain affordable. It might be benefiting from some short-term fundamentals, but long-term, it's not going to continue to grow. However, you can absolutely buy an affordable property if you look for the idea of the real estate changing because of an agent of change or changing because of a ripple of change. And without question, I think that's one of the best ways to play the game. Now, of course, you have to also buy the real estate well. Real estate, if you can haggle a good price, get yourself a bit of a discount, you're going to safeguard your next phase of investment. And of course, you could effectively get a discount and then improve the value of the real estate. Now, it's hard to improve the value of real estate if you don't get a discount. If you pay too much for real estate, you can't really add value to it because effectively you've already paid past the premium. So when it comes to buying well, if you are in a position to, on a limited budget, this is probably one of your biggest things you've got to do. You've actually got to get out and throw many multiple offers on property. You've got to go and see 20 properties. And really your probably batting average is going to be one of those 20 is one where you can potentially get a discount, potentially add value, potentially get an agent of change and or the ripple effect. So there's work to be done. It's not impossible, but it's not going to come easy. It's going to mean you're going to have to get in there and create that equity. There are some great properties with built-in equity. You couldn't replace their value today, but you've got to get out there and get into it. You've got to become more of a passive buyer, active investor rather than a passive passenger hoping the market will do the work. So my tip is really the agent of change, the ripple effect, somewhere that zone for growth is a good start. Make sure you buy a property at a discount, and if you can add some value to the property, that's even better when it comes to what next for that real estate. Now, when it comes to the market, you obviously have less control. You have less control. Markets change all the time. Market dynamics change. Short-term booms happen and then they peter out. Speculation in suburbs because they're cheap happens, and then there's too many investors in the suburb. Then one investor sells at a loss and everyone's affected. When it comes to that model, don't get sucker punched by that, because that's what most inexpensive property investors fall for. They just like the market dynamic situation. You can win, but equally it's a higher risk game when it comes to what next. What you're trying to do is get a floor price and create a ceiling price. And you can do that through effectively those four models I just gave you: discount, add value, location that's got an agent of change, and the ripple effect. You can also do it by understanding a suburb's median price. And again, like, you might find a suburb, your budget's $480 and the suburb median is $600, and you find a property that is $600,000 and it is effectively a very good middle price point, no different to the suburb mean, and you haggle on that, you can make money. So another tip would be to actually go to suburbs that are more expensive and start there. Start actually in areas which are better and see if you can bust yourself a deal. People sell for all sorts of reasons: divorce, death, distress, money issues, you name it, it's out there. So don't feel like you can't get a bargain in Australian real estate today. You absolutely can. They are out there. And so there's all sorts of ways to use a limited budget to make more money out of the real estate marketplace. But really, in conclusion, you want a few fundamentals, and I'm going to give you the check list. Firstly, you want owner-occupier appeal, whether it's an apartment, townhouse, or house. You want a good level of land value or free space value if it's an apartment. Free space value is the park next door. You want a differentiator, something with a unique feature to it so that the real estate stands out, or a feature you can add. Obviously, you want to be able to add value to the real estate, but don't pay full price for the real estate, or you won't be adding value to the real estate whatsoever. You want, because the real estate area you're looking in probably doesn't have a long history of strong capital growth, the only way around that is for you to look for an agent of change. Will people stay in the neighborhood, and will people come to the neighborhood, and why? Why? This is the biggest question you've got. And of course, the agent of change could be coming from the suburb next door. So you're going to play the ripple game, the ripple effect, which is important. Remember, you've got to also play the game of leverage. And the game of leverage may often mean just sitting back and allowing your buying power to increase by not entering the marketplace. The game of leverage could be equally the ability to restructure debt and get more money into better premium suburbs by actually going through a better philosophy of debt restructuring. So that's it, folks. I hope that was helpful. I don't know. You never know till we get to the end of these podcasts. Did I jump around a bit? I felt like I jumped around a bit, but I think we got there at the end. There was a few gold nuggets right at the end. But hey, thanks for tuning in. I will catch you on the next episode as we talk more real estate. Thanks for tuning in to the Urban Property Investor. To never miss an episode, make sure you subscribe to the podcast on your favorite app or on YouTube. I would love it if you could give the show a rating and share it with your friends and family. In between episodes, you can always keep in touch with me by connecting on social media over Facebook, Instagram, or LinkedIn. Until we meet again on the next episode of the Urban Property Investor, take care and bye for now.